In modern markets, panic is nothing new. Humans have panicked for centuries during crashes, bubbles, wars, and recessions. But today, a new question is quietly emerging inside trading floors and regulatory offices. Markets can survive human fear. They always have. But what happens when thousands of artificial intelligences panic at the exact same moment, for the exact same reason, at machine speed? In this video, we'll explore how artificial intelligence is now deeply embedded in global financial markets. We'll look at how algorithmic and AI-driven trading actually works, why it's fundamentally different from human decision-making, and why regulators and institutions are beginning to talk about something that sounds unusual, but may soon become essential: AI stress tests. Because as machines begin to shape markets, stability itself may need a new definition. Let's start with how markets used to behave. For most of financial history, markets moved at human speed. Trades were placed by people. Decisions were debated, delayed, second-guessed. Fear spread slowly, through headlines, phone calls, and rumors. Even during major crashes, there was friction. Human hesitation acted like shock absorbers. Mistakes happened, but they happened unevenly. Here's where it gets interesting. That friction is disappearing. Today, a significant share of global trading volume is executed not by humans, but by algorithms. High-frequency trading firms operate at microsecond speeds. Quant funds rely on models that ingest oceans of data. And increasingly, machine learning systems are used to detect patterns, manage risk, and execute trades automatically. According to reporting frequently discussed by outlets like Bloomberg, algorithmic trading now accounts for the majority of equity volume in major markets. This isn't experimental anymore, it's infrastructure. But there's a critical difference. Traditional algorithms follow fixed rules. If price does this, then sell. If volatility rises, then hedge. AI systems don't just follow rules. They learn, they adapt, they generalize. They identify patterns humans didn't explicitly program. And that changes the nature of risk. The coordination problem no one planned for. Humans panic differently. Some freeze, some overreact, some do nothing at all. That diversity matters. AI systems, however, are often trained on similar data, similar objectives, and similar definitions of risk. When volatility spikes, when liquidity dries up, when a rare scenario appears, thousands of models may reach the same conclusion at the same time. Not because they're colluding, but because they were trained to survive in similar ways. This is where systemic risk quietly enters the room. A lesson from the past. We've seen early versions of this before. In 2010, U.S. markets experienced the flash crash, where the Dow Jones plunged nearly 1,000 points in minutes, then rebounded almost as quickly. Investigations later showed that automated trading systems amplified each other's behavior, draining liquidity faster than humans could respond. The market didn't break because of bad intent. It broke because machines reacted faster than oversight. And that was before modern AI. Why AI changes the stakes. AI doesn't get tired. It doesn't hesitate. It doesn't feel fear. But it does optimize relentlessly toward its objective. If that objective is minimizing losses, an AI may exit positions instantly. If many systems do that simultaneously, liquidity can vanish. Prices don't fall gradually. They gap. This is the nightmare scenario regulators now quietly model. Not a rogue AI, but perfectly rational machines behaving perfectly logically together. Enter the idea of AI stress tests. Banks already undergo stress tests. Regulators simulate recessions, market crashes, and credit freezes to see whether institutions can survive extreme conditions. Now, a similar question is being asked of AI. What happens if volatility spikes beyond historical norms? Data feeds become unreliable? Multiple asset classes move in ways never seen before? How do AI systems respond when their training data no longer reflects reality? According to discussions cited by institutions aligned with the World Bank and central banking research circles, these questions are no longer theoretical. They're practical. The alignment problem. Here's the deeper issue. AI systems are optimized locally. Markets are stable globally. And AI can make a correct decision for its portfolio and still contribute to a collective failure. It's the financial version of everyone running for the exit at the same time. No single actor causes the collapse. The system collapses itself. Why humans used to matter more? Human traders have biases. They hesitate. They argue. And oddly, those imperfections added resilience. Humans disagree. Machines converge. As AI replaces discretion with optimization, markets may become more efficient, but also more brittle. Fast, sharp, unforgiving. Who's supposed to stop it? This is the uncomfortable part. Markets move faster than regulators. AI evolves faster than rules. Circuit breakers exist, but they were designed for human-paced crashes, not machine cascades that unfold in milliseconds. Some firms are now building kill switches into AI systems. Others limit autonomy during extreme conditions. But there is no global standard yet. The quiet race happening now. Behind the scenes, exchanges, regulators, and financial institutions are racing to understand something unprecedented. Not whether AI is profitable, but whether it's stable. Because once AI systems dominate liquidity provision, price discovery, and risk management, turning them off isn't simple. Financial systems have always evolved alongside technology. From paper ledgers, to telegraphs, to computers, to algorithms. Each leap brought efficiency and new forms of fragility. AI is no different. It doesn't introduce chaos. It introduces speed. And speed compresses mistakes. In the end, the question isn't whether AI belongs in markets. It already does. The real question is whether our systems of oversight, trust, and restraint can evolve just as fast. Because markets don't collapse when intelligence fails. They collapse when everyone acts intelligently in the same direction, at the same time. If you found this exploration valuable, consider subscribing for more calm, long-form stories about how technology, power, and financial systems quietly shape the world around us. This is Cold Insight. Thanks for listening.